Today we'll be discussing the proposed Division 296 superannuation tax. Despite not being legislated yet, we believe now is a really good time to start your preparation by firstly understanding your current position, thinking about what might be impacted, and thirdly, what you might like to do about it. Our discussion today, we should note, is really general in nature and doesn't take into account anyone's personal circumstances, goals or objectives. But we do recommend, if you'd like more information about your own circumstances, to talk to your trusted advisor. But today, to give this proposed tax more colour, I'll be speaking with our own expert advisors, Neil Carr, a tax specialist and partner from Fordham Business Advisors, and Richard McClelland, a partner and senior financial advisor with Perpetual Wealth Management. Neil, the first question to you. What is the Division 296 tax and how's it working?
So, thanks Meaghan. It's a tax on people with larger balances in superannuation. So if you've got more than $3 million in your personal superannuation balance, that might be spread over a number of different funds. But if you've got more than $3 million, this tax would apply to you if it was legislated. Now, as you mentioned quite rightly, it's not legislated yet. It's only a proposal. The legislation that was before Parliament actually lapsed, and now that means it actually has to be reintroduced again. And there is a lot of press out there at the moment talking about the fact that the government might be putting it on hold, might be making changes. We don't know. So at this stage, it's very difficult for us to actually talk with any clarity about the tax because we're only basing it on what is a proposal, not on what's final legislation that's been passed by Parliament. So it's a tax designed to apply an additional tax to people on their earnings in their super fund, where they have a balance of over $3 million. And it's designed to basically pay a little bit more tax on the movement in your balance each year. So if your balance goes up, you'll pay this tax. But importantly as well, if the balance goes down, the way the proposal was based, was that you wouldn't actually get a refund.
So if you go under $3 million in one particular year?
You don't get a refund of tax you might have paid in previous years, unfortunately. So again, it's a new proposal. We still need to wait and see what the final legislation would look like before we can give any sort of advice with clarity. But I think it is important for people with larger balances in super to really think about what does it mean for me and what should I be doing about it, if anything, at this point in time.
And when is it proposed to be implemented?
So it's a good question. So the original proposal was to introduce it from the 1st of July 2025, but we're here now in September 2025 and we don't have a legislation yet. So it's a good question. We don't know. We won't know until we get final legislation passed through Parliament. And then once that happens, we're going to, again, come back to everyone with a bit more clarity.
And what are Perpetual and Fordham planning on doing about this legislation?
So the key element here, as Neil said, and yourself, that it's not legislated yet. So what can we do at this point in time? Given the fact that if it was to be backdated back to the 1st of July, we need to consider client scenarios and what the best outcome is for them. It's a really interesting proposal that's before the courts at the moment, lapsed at the moment, in that the way that the tax is treated, and in terms of getting the best outcome and optimising a client's situation, you actually need to look at beyond just the super environment and look at the whole of person that's being addressed by the tax.
Assets in addition to my super
assets
property.
In addition to super, but also the wider family as well, potentially for larger high net worth individuals.
And a question that we are being asked often from clients is, what might it look like for me and how much extra tax might I be paying?
Yeah, and I think that the answer to that question is it's going to be different for everyone. Everyone's got different balances in their superannuation. The makeup of their earnings is different, and the way that they contribute or withdraw is also different. So it really comes down to getting personalised advice for your circumstances is really important. But I think the key thing to remember is it's only a tax on a proportion of the earnings, and only on a proportion that relates to the amount above $3 million. So when we talk about the fact that it's a 15% tax rate, it's not 15% on top of the 15% you're already paying. It's not 15% on your entire balance. It's only 15% on a proportion of the earnings that relate to that part of your fund that's over $3 million. So reality is for most taxpayers who have large balances, their tax under this new Division 296 might only be somewhere in the range of 5% to 10%, not the full 15% on top of what they're
Or
already
potentially
paying.
even less.
Exactly right, exactly right.
Okay. And another question is, if you do have a high portfolio balance, is it worth moving money out of superannuation?
Well, right now, it's difficult to make any decisions because of the lack of clarity. That's why, again, you need to look at your entire wealth position. And if it was to become legislated, it's important to understand that this money, if it's not in super, then where is it? And what are you doing with it? And you might even end up putting it in an environment that is a high tax environment. Individuals, for example, could have a beneficial outcome of very little tax, but also if you're a high earning individual, and typically high earning individuals have those larger balances, you could end up paying more. If it wasn't in superannuation, you consider the other structures that are out there. Individual holdings, like I said, a family trust could be an option, and I think that's something that a lot of people will turn to. But again, you need to have a beneficiary that has a more favourable tax profile. The other option could be a company, and in a company you don't get your CGT discount on capital assets as they're held for more than 12 months. And you're also still paying a 30% tax bracket. So as Neil said before, in superannuation you're probably going to be paying less than 30%. You put it in a company, you're almost certainly going to be paying around that 30% mark. So the other options can really be complicated, and it's important to talk to your advisor, talk to your tax specialist about what the best outcome is for you, but also your family from a broader sense.
And I think just to add to what Richard said, it's also really important to consider if you are going to move assets out of superannuation. Firstly, can you? Have you met a condition of release to enable you to do that? But secondly, also consider the transaction costs that might be triggered if you do that. If you're moving property, if you're moving investments that have got capital gains exposure, you might be bringing forward a capital gains tax event that could create a tax bill in superannuation. You might have stamp duty issues in terms of moving assets like property out of superannuation. So it's important not just to consider, we don't make the decision to avoid Division 296, minimise or optimise our position on Division 296 tax. It's just to create another problem for ourselves by doing that. So it's important to look at that from that whole holistic perspective, as Richard rightly said. It's not just about the fund on its own and your superannuation on its own. It's what does it mean for you as a client and your overall investment profile.
And also, what is the overall goal you're trying to achieve? Are you trying to achieve a low tax outcome, or are you trying to achieve a certain financial goal, a personal goal that you're aiming for? And making an investment decision or a structural decision based on tax and not your actual goals, we'd be wary around that, and you definitely want to speak to your advisor about that.
And it's a really broad consideration, isn't it? Something to really think about holistically.
Yeah.
Absolutely. Another question is around cash. So if this does become legislated, clients have been concerned about not having enough cash in their super fund to pay any additional tax.
Well, the Division 296 is actually applied on the individual, so it's calculated through the superannuation balance, but it's actually applied to the individual first. So you can actually pay it from funds outside of super, but in the event that you don't have that cash flow, you can direct it to your super fund to pay for it as well. So there is some flexibility there.
Okay. And what are the other options that clients may have or people may have in terms of restructuring their assets?
Looking at your overall asset allocation, there's a lot of talk about it being a tax on unrealised gains. And while it does apply in that way, it is actually not a CGT tax. It's actually a tax that's proportionally applied to balances over $3 million. So I've had clients talk to me about, well, should I not hold growth assets or capital appreciation assets in my super fund and just replace them with income producing? But income producing assets are still going to provide you with income that potentially will grow your balance as well. And also, having said that as well, the element of not having growth assets in your portfolio means that potentially over time your income won't grow either. So for your income to grow, you need your capital assets to grow. So again, making a investment decision based on tax, we'd really advise you to talk to your advisor before making that decision.
Mm-hmm, absolutely. And just drawing on one of Neil's points earlier, what if there is someone or a client who hasn't yet met a condition of release, and so that really limits any options? What advice would you give there?
Yeah, absolutely. So you obviously can't take additional money out of super in that scenario. The one thing that you may want to consider is to look at your super contribution strategy. Now, with a balance of $3 million, making non-concessional contributions is not available to you, but you may consider making concessional contributions, and what I'd suggest there is to speak to your financial advisor, speak to your tax specialist about the benefits of making additional personal deductible contributions. It may very well still be worthwhile, it may also not be. So that's something that you really need to look on a case-by-case basis.
Yeah, absolutely. And I think, again, it comes back to getting the information that helps arm yourself with the position for your circumstances and gives you the tools to be able to make good decisions about your investment goals and how you structure those investments into the future.
Yeah, absolutely. Thank you, Neil. Thank you, Richard. That concludes our discussion today on this proposed new tax. I think the key takeaways are, summarising what Neil's just said, is to really arm yourself with information to enable you to make an informed decision if and when this is legislated. We do note it is really important not to act on unlegislated proposals. And I think our discussion today has highlighted that there is no one single solution to this, and that every person has a unique circumstance. So advice from a trusted expert would be a key part of your preparation. We look forward to keeping you up to date with information as things change over time. Thank you.